You use dollars every day, you assume the government prints them, most people do, open the case, and what you find inside is something far stranger. Most of the money in existence was never printed at all. It was created by private banks as debt the moment someone signed a loan. That's not a conspiracy, that's how the machine works. Here's the mechanism. On August 15, 1971, President Nixon appeared on television and made a short announcement that quietly changed everything. The United States would no longer exchange dollars for gold at the fixed rate of $35 per ounce. The Bretton Woods system, the post-war framework that had anchored every major currency to gold and gold to the dollar, was finished. After that moment, a dollar became something conceptually unusual. It is not backed by a commodity. It is not redeemable for anything physical. A dollar today is what economists call fiat money. It has value because the government declares it legal tender, because federal law requires it to be accepted for debts, and because the United States government's taxing power creates a floor of demand. Every American who owes taxes needs dollars. That's not a small thing. Strip away the trust, and a $20 bill is cotton and linen. The machine runs on confidence, and confidence alone. Remember that. It becomes important. Here is where most people's mental model breaks. When you picture money being created, you probably picture a printing press, a government operation, the Bureau of Engraving and Printing running sheets of green ink through rollers. That process is real, but it accounts for a fraction of the money supply. Economists separate the money supply into layers. The base layer, called M0, or the monetary base, is physical cash in circulation plus bank reserves held at the Federal Reserve. That number sits at roughly $5.5 trillion. Now look at M2. M2 is the broad money supply, physical cash, checking accounts, savings accounts, money market funds, the money that actually moves through the economy. M2 is approximately $21 trillion. The gap between that and $21 trillion is not an accident. That roughly $15 trillion gap was created by commercial banks, not printed, created digitally as loans. Here is the mechanism. When you walk into a bank and take out a $100,000 mortgage, the bank does not retrieve bills from a vault. It opens an entry in a ledger. It credits your account with $100,000 that did not exist before you signed the contract. The loan itself created the money. This is called credit creation. The Bank of England described it plainly in a 2014 paper. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. Banks were historically required to hold a fraction of their deposits in reserve, roughly 10%, which meant each dollar deposited could be lent out, redeposited elsewhere, and lent again, multiplying through the system. The Federal Reserve actually dropped the formal reserve requirement to zero in March 2020, relying instead on capital buffers and market discipline. The expansion mechanism remains. More than 90% of the dollars circulating in the economy were created this way, by private institutions, as debt. When loans are repaid, that money is extinguished. When loan books expand, the money supply grows. The dollar is not printed into existence. It is borrowed into existence. If commercial banks are the creation engine, the Federal Reserve is the mainspring, the mechanism that sets the pace. The Fed was established in 1913 after a series of banking panics made clear that a system with no central lender of last resort was dangerously fragile. Today it operates under a dual mandate set by Congress: maximum employment and stable prices. Two objectives, one institution, perpetual tension between them. Its primary instrument is the federal funds rate, the interest rate at which banks lend reserves to each other overnight. When the Fed raises that rate, borrowing becomes more expensive throughout the entire economy. Businesses take out fewer loans, consumers finance less. The creation engine slows, inflation cools. When the Fed cuts rates, the reverse, credit cheapens, loans expand. The money supply grows, activity accelerates toward full employment. Beyond rates, the Fed conducts open market operations, buying and selling U.S. Treasury securities to inject or drain reserves from the banking system. Buy bonds from banks and reserves increase. Sell bonds and reserves contract. And then there is quantitative easing, the tool deployed in crises. During 2008 and again in 2020, the Fed purchased trillions in treasuries and mortgage-backed securities. expanding its balance sheet to nearly $9 trillion at its 2022 peak. The intent was to push down long-term interest rates and keep credit flowing when private lending froze. The Fed does not directly control the broad money supply. It controls the conditions under which banks create money. Think of the escapement in a mechanical watch, the component that releases the mainspring's energy one precise tooth at a time, regulating the output without generating it. That is the Federal Reserve's role in this machine. Now open the machine further, because the dollar is not just the United States currency. It is, in a precise technical sense, the world's currency. Approximately 60% of global foreign exchange reserves are held in dollars. When a central bank in Indonesia, Nigeria, or South Korea needs a safe international store of value, it buys dollar-denominated instruments, primarily U.S. Treasury bonds. Through the 1970s, as Bretton Woods collapsed, oil came to be priced predominantly in dollars, the so-called petrodollar system, embedding the currency structurally. Since every country that imports oil needs dollars to buy it, global demand for the currency became a function of energy itself, not just American economic output. Close to half of all international trade is invoiced in dollars, and in some regions far more, including transactions between countries that have nothing to do with the United States. U.S. Treasury bonds serve as the world's benchmark safe asset. In a crisis, investors flee toward them. This creates a structural paradox. When the United States runs deficits and issues more debt, demand for that debt often strengthens rather than weakens. French economist Valéry Giscard d'Estaing called this the exorbitant privilege. America borrows in its own currency, the currency the world needs, at interest rates no other nation can match. The reserve status is a subsidy embedded in the global financial architecture, and there is a harder edge: sanction power. The United States can effectively cut a country off from dollar-denominated financial infrastructure, from correspondent banking, from the ability to settle international trade. It has done so to Iran, Russia, and North Korea. The dollar is not merely an economic instrument. It is geopolitical leverage of the first order. Every machine has tolerances. Here are the dollars. Inflation. When the money creation engine runs too fast relative to productive capacity, prices rise. 2021-2023 inflation surge, peaking at roughly 9% in the United States, demonstrated that the system can overheat, and that restoring price stability required the most aggressive rate hiking cycle in 4 decades, with real costs to employment and credit. The national debt now stands at roughly $37 trillion. Annual interest payments have crossed $1 trillion, more than the entire defense budget. At some debt-to-GDP ratio, confidence in the government's ability to service that debt begins to erode. No one knows the precise threshold. That uncertainty is itself a vulnerability. De-dollarization. China, Russia, and other BRICS nations have been actively settling bilateral trade in alternative currencies. The dollar's share of global reserves has declined from roughly 70% 2 decades ago to approximately 60% today. The direction of travel is established, even if the pace remains slow. And the Triffin dilemma, the structural contradiction at the heart of reserve currency status. To supply the world with enough dollars to lubricate global trade, the United States must run persistent trade deficits, exporting more dollars than it collects. But those deficits accumulate as foreign-held debt, which eventually pressures confidence in the currency. The machine's global role and its domestic fiscal health pull against each other. No one has resolved this. It has been deferred, decade after decade, by the absence of a credible alternative. Here is what the machine actually is. A dollar is a claim on trust, on legal obligation, on the taxing power of the United States government. Most of those claims were not created by a printing press. They were created by a private banker entering a number into a ledger. At the moment, a borrower signed a debt contract. The Federal Reserve regulates the pace of that creation, through interest rates, through open market operations, through the implicit guarantee that it will act as lender of last resort when the system seizes. And the entire mechanism operates because the world has agreed, for now, that the dollar is the unit of account against which everything else gets measured, priced in oil, settled in trade, held in reserve from Oslo to Nairobi to Seoul. The dollar is a machine of trust, debt, and power. Remove any one of those three and the gears stop. The case is open. Now you've seen the mechanism. If this changed how you see it, there's a whole machine to explore. Follow along.